Hi, I'm Janae Sorenson, Vice President of Employee Benefits at Parker Smith & Feek. People seem really confused about disability insurance, but if you think about it, it's just paycheck insurance. We insure our health. Luckily, most of our employers provide health insurance for us. And we insure our car because the government says we have to. And we have home insurance because our mortgage company makes us. So disability insurance is just paycheck insurance so that we can pay for all of the stuff we just talked about. People also think that disabilities are only because of catastrophic accidents, and that's just not true. Over 80% of disabilities are caused by illnesses, not accidents. Last year, medical conditions contributed to 62% of bankruptcies and 52% of mortgage foreclosures. That's just not okay. With the average disability lasting 35 months, think about it. Could you go 3 years without a paycheck? We have solutions on how we can help protect that paycheck. We have certain best practices that we like to look at in disability insurance policies. The first thing we look at is taxability of benefits. So the government's going to get their money on either the front end or the back end. So what that means is the government is going to take taxes either on the premiums that you pay for disability insurance, which are usually pretty small, usually under $20, $25 a month, or they're going to tax your benefit, which could be 60% to $7,000 a month. So what we do is what's called a gross up. So we increase the employee's salary by the amount of the premium. Then they do a payroll deduction. So the government's getting their taxes on the premium. That means if someone becomes disabled, that benefit of thousands of dollars is tax-free. Most plans that we see, actually 90% of them, insure salary, base salary only. Now I don't know about you, but most of our employees have a base and then also a bonus. So if an employer has a base salary and they're only insuring disability insurance for that base salary, you could be getting a really small percentage of your income in a disability check. So what we like to do is include base salary, commissions, bonuses, any sort of variable compensation. And that means that when you get, let's say, 60% of your income as a disability check, then you're truly getting 60% of what was your take-home pay. No one ever thinks about this, but if you become disabled, contributions to your retirement plan stop. Your employer is no longer legally allowed to contribute to your retirement. We like to look at what's called a retirement contribution benefit. So whether it's a pension or a 401k or an IRA, the benefit can be put in there in addition to paying you a benefit to help take care of your family. There's an opportunity for reverse discrimination with disability benefits. What that means is that your higher earners aren't receiving as good of a benefit, the same percentage of income, as everyone else. So you want to make sure that all of your employees are receiving that 60% of their earnings. So what we can do is put individual disability insurance on top of a group disability insurance plan. So instead of an executive or a salesperson going out and earning only maybe 42% of their income, they can earn up to 80% of their income. Thanks for taking the time to learn about disability insurance. If you have any questions, there's a great website called disabilitycanhappen.org. It'll give you all the statistics that you need to know, as well as there's a quiz that allows you to determine what your chance of becoming disabled is. Have a great day.